big red, that is a simple exercise, but based on the indirect method, so that you can see how the indirect method is working for cash flow statements. They give us a statement of financial position as of 30 September 2010 Rand, 29 Rand. Assets, non-current assets, property, plant and equipment, you can see quite a movement. Financial assets at cost, 40,000, 23,000. Don't forget this one. Always mark it for yourself, because they don't ever, or not never, but very seldom, they mention this financial assets again in the question. And clearly there was a movement. There was an increase, which is an investing activity. Inventory, trade debtors, cash and cash equivalents. Last year a positive balance, and this year a bank overdraft. So there was an outflow of cash of 10,000 Rand. Share capital, there was quite an increase here, but look at this one. Other components of equity equals share premium. Now we had share capital there of 640,000. There we have share premium of 28,000. No share premium last year, and then we obviously had a balance of last year 520,000. Now, you will probably not get something like this in a test or exam, because we are not allowed to issue any shares at or no par value shares. So that means that you cannot issue a share at a price higher than the issue price, because you're going to, it's a no par value share. Whatever you want to receive for the share, you're going to make the issue price. But in the old days, when you had to issue, or when you had issued par value shares and you have issued that at a price higher than the par value, that surplus amount above the par value of the share was taken to the share premium account. So talking about cash flow, what would I have received? I would have received the par value plus the surplus funds less last year's equity capital. Right, retained income. Then we had secured bank loan. There was also a difference. Trade creditors, receiver of revenue charged for income tax, bank overdraft, and equity and liabilities. Then they also gave you abbreviated income statement. They gave you gross profit, operating profit, other income, investment income. You know that's a separately disclosable item, so let's mark that. Finance cost is a separately disclosable item, so let's mark that one. Profit before taxation, income tax expense, and net profit after taxation. Now, they tell us the net cash generated by operations amounted to 124,600. Depreciation amounting to 35,000 was included in determining the operating profit, included in other income. Now, other income, and then they include the loss. I don't know who actually compiled the statements, because he doesn't know anything. But nevertheless, there was a loss on the sale of machinery, a non-cash flow item, of 2,000 Rand. Then ordinary dividends of 28,800 Rand was paid during the year. During 2010, machinery with a cost price of 42,000 and an accumulated depreciation of 31,000 was sold. So what was the carry value here? Carry value then was 42,000 less 31,000 equals 11,000. They've just told me that we made a loss on the sale of machinery of 2,000. So that means I've received less for the machinery than what the carry value was. So I have received 9,000, which was the proceeds on the sale. And that I do need for my cash flow. I need to show my proceeds on the sale of assets. And then obviously we have already said that that's a non-cash flow item. Shortly after the sale, new machinery was purchased to expand. So just make sure that you're going to indicate the new machinery, and it's going to be for expansion purposes. Okay. Then they give us property, plant and equipment. They give us the breakdown of cost, accumulated depreciation of machinery and equipment, and the book value for both years. Land and buildings, you can see there is an increase of 50,000. Nowhere have I seen anything about revaluation surplus, so therefore we have purchased land to the value of 50,000 Rand. Also, I cannot see any accumulated depreciation on land, so therefore it's probably the depreciation policy not to write off any depreciation on land. Good, I want you to prepare the cash flow for the year ended 30 September 2010 by using the indirect method. Very important that you actually know what method to use. We said with the indirect method, we move the note, which is the reconciliation of the profit before tax with cash flow from operations, onto the face of the statement of cash flow. So our statement of cash flow is going to start with this figure here, net profit before taxation, 92,400. So proper heading, Big Red Limited statement of cash flow for the year ended 30 September 2010, and then in this column you should have shown 2010 Rand. Cash flow from operating activities, we're going to start with profit before tax, 92,400. Now the first thing that we're going to adjust our profit for is for non-cash flow items. And they gave us all the non-cash flow items very clearly here. In depreciation amounting to 35,000 was included in determining operating profit. So therefore we're going to add back that depreciation, and there was also a loss on the sale of machinery of 2,000, which is also not a cash flow item. So we're going to add back the depreciation. Why? Depreciation decreased profit before tax. So if I want to eliminate that, I have to increase my profit before tax again. And the same thing applied to our loss on the sale of the machinery. That loss reduced your profit before tax. If I want to eliminate that, I have to increase my profit before tax again. Then we are going to adjust it for separately disclosable items. Now, there we had dividends received. That's a separately disclosable item. And finance cost is also a separately disclosable item. Dividends received increased my profit before tax, so therefore I'm going to take it out. Interest paid decreased my profit before tax, so if I want to eliminate that, I have to add it back. Then changes in working capital. Now, because we're working with everything, it is going to include all my working capital changes, starting with the changes in inventory. There you can see there was an increase in inventory of 13,000 Rand. If inventory increases, it is a cash outflow. I'm actually investing more in inventory than what I did before, so it's a cash outflow of 13,000. Trade debtors, 34,000, 39,000, so there's a reduction of 5,000 Rand in trade debtors. So that means that they've paid us, so it's an inflow of cash. Decrease in 5,000 Rand, decrease in debtors, increase in cash flow. Cash and cash equivalents is a whole category on their own. Trade creditors, there's quite a nice increase of 2,500 Rand in trade creditors, which is also representing an inflow of cash. So it's a positive figure, 2,500. So cash generated by operations, 124,600, and if you can remember correctly, they actually gave me that figure, so I had something to balance back to. So there's the 124,600 which they gave me there, and there's the 124,600 which I have actually determined there. Good, now it is our separately disclosable items. Dividends received, and they have told us our dividends received was 3,800. Dividends paid. They were also so kind to give us that figure, 28,800. Interest paid. They gave us our interest figure in the income statement. Finance cost, 4,500. So remember that your brackets in a cash flow statement must be correct, because if your brackets is not correct, I can't award any marks for your figure without the correct bracket indication. Okay, so that is in the dividends paid, interest paid, and now tax paid. Now remember, this tax is not our income statement expense. Here we have to determine how much did we actually pay to receive of revenue. So in the beginning of the year, we owed him 17,000 Rand. Then there was an additional 26,100 that we had to pay him, and we have Still, at year end, an outstanding debt, we still owe the receiver of revenue 14,000 Rand. So you have to draw the T account. Opening balance 17,000, closing balance 14,000. Here's our income tax expense in the income statement, 26,100. And now our balancing figure on the debit side is what we actually paid to receiver of revenue, 29,100. So cash flow from operating activities then, 66,000 Rand. Investing activities. Now the first one there, increase in investments. Remember when we went through the question, we said please do not forget this financial assets. There was an increase of 17,000 Rand. It is an outflow of cash, so we have to show that for you as an outflow of cash of 17,000. If you remember our land and buildings, there was quite an increase there of 50,000 Rand. So the purchase of land and buildings, 50,000, and I think it is fair to say that that is going to be for expansion purposes. So let's put that in there as well. Proceeds from the sale of machinery. Now we've worked it out already. It was here where we said that the carry value of the asset was 11,000. We made a loss of 2,000 on the sale of the asset. Therefore, we must have received 9,000 Rand for that asset. 9,000 Rand. Here we've worked it out once more. Proceeds, cash inflow, we received the money. Now we have to reconstruct our machinery at cost price account, because they've told us in the question that new machinery was purchased to expand the operations. So at cost price, we're going to start off opening balance 260,000, closing balance 344,000. The cost price of the machinery sold was 42,000 Rand. So that obviously will also be in the machinery account. Opening balance 260, closing balance 342. We have transferred to the asset disposal or the asset realization account the cost price of 42,000. So the balancing figure on the debit side of the machinery account, 126,000, and they've told us that that is for expansion purposes, 126,000. Issue of shares. We did quickly talk about the issue of shares. And we've said that obviously they had par value shares and they have issued it at a premium. So I'm going to compare 668,000 Rand, the two of them together, with the 520,000 previously held, and that is going to be my increase in my shares of 148,000. Our bank loan we've seen has actually reduced from 64,000 to 24,000. So there was a reduction in the loan, so we have repaid some of our loans, which is 40,000. Cash flow from financing activities then, 108,000 cash inflow. Then our net increase or decrease in cash and cash equivalents. Here we've seen we had an overdrawn balance, a positive balance, in the beginning of the year, and an overdrawn balance at the end of the year. So our cash resources has declined with 10,000 Rand. Now if we're going to go back, we're going to say, good, if we're going to add the 66,000 cash flow from operating activities, we're going to deduct the cash flow from investing activities, we're going to add the cash flow of financing activities, 108,000, and that must bring us back to the net increase in cash and cash equivalents of 10,000 Rand.